We have a good mortgage question from Susan Sullivan on Dunbar Street in Vancouver. Susan would like to know what the differences are between a variable open and a variable closed mortgage.
That's a good one from Susan. I guess we got to take a step back and figure, okay, so what is a variable rate? Well, a variable rate is tied into the Bank of Canada Prime. The Bank of Canada Prime is a rate that the government of Canada uses to control inflation. So if inflation is going up, they have to raise the rate. If inflation is going down, then they want to lower the rate because they want the economy to keep on moving along. So the variable rate is tied in with the prime. In the old days, you'd have a discount off the variable. In some cases today, the variable is the same as what the Bank of Canada Prime is. So Bank of Canada Prime is at 3%, so you can get a variable rate at 3%. Now, there are some lenders right now that are offering a discount, and so that discount is anywhere from 0.1 to 0.4. So we have a 2.6 variable rate mortgage. So when she's asking the question about what the difference between a variable rate open and a variable rate closed is the variable rate closed, which would then be the discounted one, is closed in the aspect that you can't leave that particular lender, but you can lock in anytime you want. So you have the freedom to lock in, you just don't have the freedom to leave. If you want to leave, you got to pay the payout penalty. On a variable open, that's normally a half to a 1% above the prime, so that's either 3.5 or 4. And what that means is that you're expecting to win the lottery this weekend, you're getting an inheritance coming in, you're going to sell your home, and so therefore you don't have any payout penalties, so then you would take a variable open mortgage.
Thank you very much, Bill. And for expert mortgage information online, visit billymac.com. That's Billy with an I, not a Y, mac.com, or call Bill at 604-684-4663. That's 604-684-HOME.